Welcome to the closing beat, everybody. Happy Monday. How you doing? Did you have a good weekend out there? We were rather busy here. We're financial advisors here with Jazz Wealth Managers. It says so on the shirt, so you know it's official. We do this show every day, just try to help learn, teach you guys a little bit about the stock market. Got some interesting stats to share with you, so stick with me till the end there. We'll go over the bull market, current bull market statistics and everything, kind of share with you some of the geeky stuff. We also cover the markets top to bottom here. We're playing a game. If you want to go to the bottom right-hand corner of your page, it's called jazzwealth.com/guess the Dow. Just tell me where you think the Dow is going to close next week. And if you're the closest without going over, we'll send you a $100 gift card. Or if you're one of our customers, like our winner last week, Mr. Enrique, we will credit your account the $100 if you prefer. You want to see something neat? I figured this out here just a second ago. I can actually tap into our security camera here. And if you want, let me see if I can pull it over. So that's part of our set. That's me over in the corner there, waving. That new thing that you see there, that's the speakeasy. That is set 3J there. It's actually a bar. I can zoom in, I think. Oh, fancy. So I didn't have a chance to move the camera there, but there's sort of the finished product of what we've been working on there. It doesn't look real good. It's going to go jittery for a second, but that is set 3J. It's our bar. We do our classes on Thursday nights for our customers live from that bar, which is a fully functioning bar, I might add. Just because, you know, why not, man? So try to share more with you guys about what's going on behind the scenes here if you're interested. But enough of that. Oh, this Thursday's class will definitely be from the bar there. We're going to do a class on trading plans. So just keep that in mind. If you're trading, you're active out there, you don't have a trading plan, we're going to go through that. I've taught tens of thousands of people all over the world about trading plans, and so we're going to go through them, share some of that data with you there if you want to play along. All right, so the S&P 500 higher today by 16 points. That's a new record high. The Dow was higher by 132. The NASDAQ gained 82 on the day. It's only new record highs for the S&P 500. So we'll go over to the charts real quick, share that with you. S&P 500, we kind of had our lines here for what seemed like forever. We talked about the last time it hit these highs, pulled back 7%. Last time it rallied up, couldn't get above the highs, pulled back 6%. This time so far, it's broken above on a closing basis. So traders, technical traders, will call that a break to new highs officially because it closed above there. This is the first time since just before July that the market's actually been back to 52-week highs after being below them there for it's almost 3 months, right? So we thought, well, what does that mean? Does that mean anything if your strategy was to buy a little bit of the market every time that it hit new all-time highs and play that momentum, would that be better than waiting and buying only the new highs after the stock market was below those new highs for a while? In other words, it hit new highs, pulled back and floundered around a little bit. Then the next time it goes to new highs, that's where you buy, right? Let's assume that that was your strategy. So we went back and we compared doing that, buying only new all-time highs after they've been sort of below those highs for at least 2 months or more, versus just buying the new all-time high. And what we did is we looked at the performance from 6 months out to a year out. So what do we got? What's going on there? So if you were to look back and see how many times that the market has broken to new all-time highs after being below it for at least 2 months or more, you actually find 32 other times in history. Go all the way back to 1928 for the S&P 500. I would have thought more, to be honest with you, but only 32 times. If you look 6 months later, the average gain is 5.3%. And you go, all right, well, if you bought all-time highs after they were below those all-time highs for at least 2 months or more, 5.3% average return's pretty good, right? Seems okay. If you look 1 year later, the average return's 11.18%. So that sounds good. You look at how many times you were negative, only 9 times out of the 32 were you negative, or it's like 28% or something like that. was the performance negative. Now, compare that to if you just bought all-time highs, right? Anytime it happened, you saw a new all-time high, you added a little bit to your portfolio. Next time you saw a new all-time high, no matter what happened previously, let's say you just added a little bit. If you go 6 months after every single time that's happened, that took forever, 3.78% return. So there's let's just go on. So a year later, 7.79% return. So remember, the first ones I explained, 5.3 and 11.2, let's call it. The second ones we explained, just buying all-time highs, 3.7 versus 7.9. So better returns if you wait for the markets to build up some steam below those all-time highs, and it's sort of a fresh breakout to highs versus just any breakout to new highs there. What it boils down to is basically a 72% chance that you get an average 3.3% better return by only focusing on breakouts when the markets have been sort of below those highs for at least 2 months or more. What does that mean? Nobody's doing that. I get it that nobody's out there like buying the markets every time it hits new highs. Maybe that's your style, but most people don't do that. What it tells you is that breakouts after the markets have been quiet for a while are just have a little bit more juice. That's it. So if you're looking at this breakout going, yeah, but what about the recession? What about impeachment? What about elections? What about healthcare and all this stuff? You look at that and you go, well, look, we've been below those highs for a while. Statistically, there may be a little bit more juice here in this one. We'll see. Now, I'll go over in a minute why I kind of think that this may be an exception to the rule, but these are just my opinions. Also, in the markets, there's a poll done by Barron's called the Big Money Poll. It's called the Big Money Poll, where they sort of poll advisors. They never ask me, but they poll advisors and they say, what's your outlook on the markets? They get all these different questions. And it's a pretty popular poll. They do it twice a year. And the response to this most recent poll was the most bearish that all these professional money managers have ever been in history, that they've ever done for the whole time they've done this poll. Most professional money managers are expecting the markets to pull back. Now, this poll's already old, right? Wasn't done today. And so that's crazy, right? Everybody's bearish, but the markets keep moving higher. Or professional fund managers and things like that are bearish, but the markets keep moving higher. We'll go over some of those stats there, try to share that with you. But I didn't mean to start off Monday on a geeky note, but we're going to finish on a geeky note too. So hang in there. All right, here we go. Your biggest movers week over week. Your biggest mover last week was energy. We talked about that on Friday, coming up off the lows there. Today it finishes a little bit lower because the price of oil down a little bit. Hit the 200-day moving average, lost 1.5% today. Not a big deal after a nice move last week. Very much directionless, choppy, sloppy mess, indecision, if you were to look at the price of oil in general there and kind of wonder what's going on. Tech was also a good mover last week, continues to be a good mover this week, right? It's following up on that late week move that it had, broke to new 52-week highs, and we talked about this last week. You need tech stocks and you need financials if you want the markets to break out. Today you had both of them, right? You've sort of been watching them build up steam for this breakout. My problem with it is, if I look at things like JP Morgan, super extended, big leader in the XLF or the financial space there. I'm just thinking of names here. I haven't pre-wrote this down. So Bank of America, you got very extended there in the short term. What about Citi? Not too bad, right? So Citi maybe not as extended there. Wells Fargo is in the news today and also extended in the short term. If those financials pull back and you look at tech and you go, well, okay, that's a little bit overbought there. In the ultra short term, it kind of makes you think, well, hey, maybe this breakout isn't going to have as much juice in the short term as we thought. So we'll see. I don't know. I'm talking ultra short term here. We're long-term investors. I just like going over things with you in the short term as well. So we'll see what happens there. Healthcare, by the way, I use the XLV to track that. Not a recommendation in any way. I just use it to track it. We've been talking about healthcare getting sort of stronger and stronger and stronger, and the analysts that cover this area getting more and more bullish. That's continuing, right? So even though we went through all the data and all that stuff, that's continuing. It's just not as exciting to cover. Just know that the bullish stance by analysts and people that cover healthcare stocks in general, it continues, right? So healthcare added 1% higher on the day. To the downside, you're going to find silver a little bit lower on the day, 1.25%. You go over and look at the price of gold, whether you look at the futures contracts directly or you look at ETFs, either way, up to you. Down 1% on the day, sort of chopping around a little bit. Not a big deal. Gold miners a little bit lower on the day. I saw hedge fund locally here had to shut down because their bet on the gold miners didn't quite pan out there. Well, that's what it is. You got REITs moving lower again. So nasty kind of finish to the end of the week. They broke through the 50-day moving average again, closing below it in the short term there. Utilities were also lower. Same thing, back below the 50-day moving average. These had a great run, right? So bottom line is, if they pull back for a while, I think a lot of people would be happy that they did pull back. Also, you had the yield curve steepening today. Again, so the yield curve has been steepening. You remember a couple weeks back, it was, yield curves are flattening. That means recession. It's inverted. That means recession. Well, we went through that with our customers. That's not actually what it means. We showed all the data and everything. So just a friendly note that the yield curve is continuing to steepen, now about 17 or 18 basis points apart if you're covering the 2 to 10s, if that's how you like to look at it, which is what we look at there as well. You got the Fed announcement on Wednesday, so be ready for that, of course. You've got 65% of the S&P above the 50-day moving average. That dropped a little bit. It's weird. We had a record day, but yet less stocks are now above their 50-day moving average. What do you think that's coming from? Utilities, REITs, right? Because all those stocks have been pulling back a little bit. Not that that's bad news. It just means they're pulling back. That sector is now not contributing as much to that daily data number that we give you. 69 names are within 2% of crossing above the 50-day moving average. That number was 59 on Friday, if you remember. So why is it getting better, right? If you look at it, you just had a lot of stocks that were like 3 to 4%. They had a good day today. Now they're within 2%, so totally cool with that. You got 39 new 52-week highs on the day. It sort of seems low for such a record day. You have only 82 of the S&P 500 is within 3% of making new 52-week highs. Sorry, told you. We're just going to lay it on you today. Soak it up, hit rewind, slow it down, whatever you got to do. 82 names in the S&P 500 still have 3% or less before they hit a 52-week new high there. 66% of the S&P 500, two-thirds of the S&P 500 still has 5% or more to grow before it hits new 52-week highs. Like we said on Friday or Thursday, you could see that as good news or bad news, right? Now, I'm not talking about the 50-day. I'm talking about making new 52-week highs. You could look at that and say, well, 66% of the S&P still has room to run to further juice this market higher. Or you could look at it as a sign of weakness and go, why are two-thirds of the S&P still not near 52-week highs? We got 5% or more to go, but yet the markets are at all-time highs here. That means it's a sector-based move instead of all just a broad-based rally, exciting kind of a move there. If you're interested in some of the names that made new highs today, Microsoft, we'll cover that in a second. Gap to new highs, 2.5% higher today, breaking out above that really sloppy but long range there. You've got Alphabet or Google hitting new highs as well. All those semiconductors we talked about the other day, KLA-10 Core, Lam Research, if I could type and talk, still just monster moves here continuing. That's all trade-related news. Everything is just looking good there. Final pen being put to paper on the first part of the trade war. That's hard to say. And so 4% on Lam Research. Applied Materials also higher on the day. Just real strong here in the short term. So that's why you got semiconductors, which you need for a strong market. So you're either happy about that or not. The relative strength oil stocks now getting a little bit frothy, if that's a word we can use. Phillips 66 up 2.4% today. Massive move over the last 4 days. Seems really extended to me. Valero also same thing, but not as much juice today. See how quiet it was? It did hit new highs, but you didn't soak up as much people. Technically, from a distance from the 50-day moving average in terms of number of standard deviations, VLO beats, so it's a more obvious to the algorithms that it is more overbought in the short term there. As far as our stats plays, you got Travelers Insurance not helping the stats. It's got to make it to this line. It's got 3 days to go to fulfill its stat of an average gain of 2.86%, and not there. You still got some work to do. Let's go over some stocks here. Do I have stocks to list with you? I wrote down some stuff. Yeah, I still use paper. All right, let's talk about Microsoft real quick. So Microsoft did break to those new highs. They got that $10 billion JEDI contract from the government. Amazon says, we're going to find a way to protest this. So Amazon shares a little bit volatile here. All in all, it finished up on the day. But Microsoft enjoying that one. You've got PG&E, which is oddly ticker symbol PCG if you're following. Shares moving to new lows there. They're cutting power. I talked to a lady today that has no power in California. I feel bad for you guys. It's a tough one. But the governor of California asked Warren Buffett's company to buy PG&E. And if you think about when Warren Buffett, he's already got some exposure out there in California utilities. So if you think about it, maybe a good deal for him. This is a great example and one of the great examples of why you personally run your money like companies do. And I know I'll get some grief for that, but this week in our 1 o'clock classes, I'm going to cover a lot of that and say some things that may be a little controversial. But if we think of your personal finances like Warren Buffett runs his business, or we think of your personal finances like Walgreens, I guess I'll mention that in a minute, and how they manage their money. If we just approach it like that, I mean, what a better example can you use? You may not like these big corporations, but look at the way they manage their money. These guys are not idiots in how they pinch every single penny, get every single loophole and availability that is out there for them. So Warren Buffett likes a good discount. Who knows? We'll see. We'll see what he decides there. But he's got plenty of cash ready to spend. Follow the big guys. All right. Well, let's do Walgreens here. So Walgreens was up just a little bit on the day today. Walgreens beat their earnings. That was great. Revenues are basically as expected. Guidance was in line. So it was just basically an okay earnings announcement. But they said, listen to this. They were previously had put together a plan on how to save $1.5 billion by 2022. That was their plan. How do we save one? So think about you. You're trying to save $1,500 in the next year or two, or $15,000 or something. They want to save $1.5 billion. Whatever it takes, all hands on deck, go find ways to save money. You know, refinancing their debt and taking on more debt is part of that plan, right? But God forbid anybody mention go take on debt to get your dough straight. What's that all about, right? These guys crunch the numbers, figure out the best way to do it. Anyways, they upped that number. They said, we've done so well finding ways to save $1.5 billion with our creative financing and everything, and the fact that they're not even based in the United States. They don't pay us. Anyways, they're changing it to now 1.8. They think they can save $1.8 billion by 2022. Wouldn't that be an interesting study to go study how they're going to do that and see if you could apply the same metrics to your personal finances? Absolutely. I will take the complaints if you have any. Willingly. AT&T up 4% today. They had a good earnings announcement there. Earnings were basically as expected. Revenues did come in slightly weaker. Lots of little things here if you read into it. They were expected to lose 84,000 wireless subscribers. They actually flipped it. They gained like 100,000. And I'm not making that number up. It's somewhere right around 100,000. So that was good news. They also had a meeting. They're sort of in sort of a nice, fun gentleman's argument with Elliott Management. It's taking a stake in them. And they said, we're going to find ways to improve shareholder value. So one of the ways is they said they've got a 3-year plan to consistently, actually the word they used was modestly, raise the dividends over the next 3 years. That's exciting because people play this stock for the dividend for the most part. It's not known for being a growth stock. So over the next 3 years, they have a plan in place. They are going to consistently raise the dividends. So all you dividends traders out there that love these stocks, there you go. You got a good one there, at least in terms of their commitment. Spotify, 16% higher on the day. Not bad, right? Their CEO or somebody's resigning. He's done. CFO, he's going to step down there. But they added 113 million what they call premium subscribers, just people that pay money. We got Spotify running all the time. I don't ever recall them asking me to pay any money. We don't pay them. But anyways, they got 113 million subs. Premium subscribers, they call it, versus 111 million they were expected. So a lot better than expected. Spotify in general, they beat expectations by a total of, I guess that's about 65 cents. They were expected to lose money. They made money. Hey, all good. So if you happen to own some Spotify, really cool there. Looking good for them. All right, what else do we have here? Tomorrow, decent amount of earnings. You got MasterCard, something you probably, most people own or want to look at. General Motors coming off of their contract negotiations there. Pfizer and Merck will be reporting tomorrow as well. Mattel reporting, we'll see after the close. And ConocoPhillips, A lot of oil service companies reporting. I don't usually cover those. Diamond Offshore, I believe, is in the mix there. They reported today, didn't they? Diamond Offshore reported today. There's just a whole host of them. And then a Fed announcement, of course, coming up there. Did you happen to see on Friday, all over the place now once this happened, and today I noticed the volume was all over the place. On Friday, there was a 50,000 contract call purchase on the VIX. So if you're not familiar with what the VIX is, this is not going to be a VIX class, but the VIX is a measure. Sorry. Someone's making a large bet. It's a 5 million share purchase there, $500,000 buy. They bought 50,000 call contracts for 10 cents is what it went through as. That's incredible. Now, it's at 65, right? So I'm going to try to pull this up. Make sure we're doing everything. Okay, yeah. So here's the VIX. Let's try this here. We go back, put this up. The person believes now, basically the trade, if you're not familiar with options, the bet was that by April of next year, the value of the VIX will go to $65. Now you see we're at 13, right? So they think it's going to spike well beyond. In fact, you have to go I can't even go back that far. I'm sorry, I can't even load it up at the moment. I don't have it prepared. So you have to go back to 2008 to find the VIX at 65 or higher, post-split, right? So just to look at it in that respect. So somebody's making a massive bet that the stock market is, by April of next year, will experience some sort of catastrophic drop like we did in 2008. Could be protection. It could be a random bet. Could be somebody with a lot of money just taking a shot. I don't know. But because of that, today what you had is other people finding that out and going in there and placing all their bets. You had just a ton of volume. I can't show you on here. It won't pull up the volume. But you had volume all over the place in those way out of the money option contracts. What do you think? Leave a comment below. What do you think about that VIX down there? You think that's a strong likelihood or not? We'll see what you think there. All right, finally, bull market statistics here. Today, I saw it on Bloomberg, is officially the 3,885th day of this bull market. That's just about 2,000 more days than the last bull market. So the whole thing that led up to the financial collapse there. We're 2,000 days further than that. Now, if you look at the S&P 500 in terms of where our return is for this bull market, puts us up 350%. The average is actually 100. So if you look at all the bull markets as measured by the the standard sort of definition there, the average bull market 154%, and right at 1,700 days. We are at 3,885 days in this bull market. It's not the oldest, or it's not the longest bull market in record. So you got to go back to the October 87 crash. If you go from there to the year 2000, I believe it was March of 2000, that is actually a total of 4,494 days. That's 2 years further, right? From this point, we'd have to go another 2 years, right? So S&P actually gained 582% in that bull market. So for those of you that go, this is a crazy long bull market for the S&P, there's technically one that's a little bit older. I mean, there's different ways to measure a bull market, but sort of the textbook analysis of it, there you go, right? So is there more room to run in the markets? We will see. All right. I'll take your questions if you have any. We'll see what we can do here and go from there. What do we have? Is dividend growth an oxymoron? It has moments in time where you think it can actually happen, and unfortunately, I see so many of these YouTube videos where people are like, we have a $6,000 account, and look at our dividends. We made 14 bucks or something. And it's like, what's the goal? What are we trying to do there? Like, it's a little bit frustrating there. It has moments, right? You get stocks like AT&T that temporarily go into like a little growth stock mode. And it looks like all of a sudden these stats are skewed there, so it's tough. Cool. Somebody kicked the... I love it. Do you like McDonald's for an investment? Do you think McDonald's will be ready for a bounce at this level? If not, what price should be considered? You're asking really specific questions I'm not allowed to give. I do like the sell-off in McDonald's. I like how extended it's gotten in the short term. If you haven't looked at McDonald's, let's pull it up just because we can. Look at this quick sell-off here in the short term, just a nice little drop there if you like discounts. If you own it and you're saying, well, I've been waiting for an opportunity to add to it, I can't blame you for wanting to add there in the low 180s, right? But in the short term, lots of volume there. You got lots of reason to say, well, if you liked it at 200, you know, you must love it at like 180 or something. So I couldn't argue with someone wanting to add that to their portfolio. I cannot tell you to go buy it or sell it or do anything. Thursday nights, that's when you want to join us for things like that. Thursday nights, we're going to start expanding on that, but our wine and wealth class for our customers, I always go over something new. This week will be trading plans, and then if anybody has detailed questions they want answered about stocks, that's where I can do that and not get in any trouble legally. Yeah. Boy, I saw the news just out to just totally bust up on Tesla today. Just everywhere. It was like negative headline, comments about the SpaceX and everything. I'm like, Jesus, what do they have against this guy? I thought that was crazy. I'm not going to comment on 3,000. I don't know what the question is on that. Could you make a video on which 401k funds you recommend to invest in if you choose to stick with the 401k? Not really, because every 401k is a little bit different. They give you a menu of choices, so it'd be hard to kind of know who has what choices. Now, I can say the industry is sort of consolidating towards basically the same choices. I mean, I look at no less than 100 401ks in a month, seriously, and there's this clear consolidation towards target date funds and what companies they're going to use. You know, your index funds, your sector-based funds, they're all sort of, there's a bunch of good sales guys out there, I would say, that are getting all these 401k companies to use, getting all these companies to use the same products. Yeah. Yeah, I'm sorry, Jeff, I just can't, yeah. You can email me. I'll give you a detailed email, or I'm happy to do it there. Cool. Tiny gold mine. I don't look at a lot of the smaller gold miners. I love the gold mining sector in terms of the stocks, the behavior. I don't mean like where they're positioned, but I love gold mining stocks, their personality. My favorite stock of all time to trade actively used to be Amana Gold, or Yamana Gold, I guess. It's not, oh, it is still around. Yeah, it's only $3 now, but used to be in the teens, and it just, the personality of gold miners. You ever notice that? Who's active trading out there where maybe you got your long-term stuff going on, but you're out there actively trading and you just happen to find the right personality of a stock, right? And you just kind of like it there. I always found that good with gold miners. So I couldn't offer a lot of in terms of that one because I don't know that one in particular. Looks like in the short term though, it's attempting a little pressure to the upside there. Very sloppy overall. I'd probably wait. I saw Beyond Meats, they beat on earnings. They actually made a little profit, right? The stock was still lower. I believe it's still lower, down to 97.50-ish, 98 almost, back and forth there. Large spread after hours. So it's got a good gap down coming tomorrow for it, but I didn't look through the earnings. I just saw they beat. I thought, wow, well, good for them. I didn't catch it. I'm not sure why it's gapping down, though. Yep. Some kind of technical analysis on ATVI. This was pretty straightforward, actually. If you want to look at the this price overall, look at your series of highs here. You know where everybody wants to sell, at least in the short term. Somebody wants to sell, or a group of people have decided they're not willing to buy over 56.50. So I'd actually let it break above that first, and before I even considered taking a second look at it. I liked it back here. We talked about this sort of move out of that range there. A little quiet in the short term. That's okay. It happens, but that would be probably where you see the next excitement. A convincing closing move above 56.50, I'd imagine. Yep. Kevin O'Leary told you personally he hates the gold miners. It might be a tough investment, but as a trade, you know, it's just something about it. I got along with that stock. You know how I say I don't talk about biotech stocks? I didn't get along with those. I can't figure out how those things move. I didn't like buying and selling them. I didn't like being a part of it. And, you know, the personality, we didn't get along, so we broke up. That's how it works. I don't mind admitting it. Same with Forex. You don't hear me mention Forex much. We just, you know, we don't get along. Know your strengths, know your weaknesses. Yep. Volatility of cannabis stocks. Yeah, I mean, you see a lot of that.
Hey, wait.
Oh, sorry.
You go watch one of our
Look at what, you see what I do? You see a lot of volatility in the cannabis stocks lately, especially as they've gone through earnings. There was a brief moment of excitement, and then everybody else came back and said, wait a minute, they're still not worth that much. So no matter what stocks you look at, little bitty pops there in the short term, all earnings related, and then back to normal. That's a tough area to be involved in. I get it. They're all trading discounted to where they've been, but give me some reason to believe that they're going to be profitable. Give me something that shows these guys have a fighting chance compared to just buying it from, whoever you know down the street. I like it. What are your thoughts on Nokia sell-off? You looking at? You like that one there? So remember, when a stock falls, such as this is a great one, great example here. When you have this sort of massive gap down, and it's not a split-related gap down, it's an actual gap down, that is not one that you walk in front of and say, well, I'll take that discount. Careful when these things happen. It takes time. They got to rebuild, man. That's a tough one. All right, a couple more. And if you're looking at 5G, I see the second part of your question. Go elsewhere. If that's your main metric for wanting to look at stocks like that. Yep. Be careful. Oh, yeah, don't forget the Fed Wednesday. I think I mentioned it already. Yep. We do a lot of stats here. Big fan of data, just looking at things from that kind of perspective, because time and time again, you can kind of see how they play out. We'll share some of these stats with you, even in terms of where stocks move and how they move, overbought, oversold, things like that. I find it's just better to share them with you guys than to just pretend like I have an opinion about it. A lot of people just, maybe they're looking at stats too, and they try to make it seem like it's their opinion. I'd rather let you guys know that it's stats based. You could buy data and stuff and then run stats any way you'd like that fits your style. And that's just something that fits our style. I like looking at everything every day. Yep. Okay. Yeah, that's in the news there as well. Google apparently looking to buy Fitbit. Bloomberg said earlier, where were they looking? Apple's going to start looking at smart home type products. They're going to start with software. I think it's a rumor at this point. Ford, their S&P credit rating got lowered at Ford, but I don't think the stock did a whole lot. Down 1%, it's not so bad, but that's not a good sign. All right, well, I appreciate you guys watching. It takes a lot of work to put this together, so I appreciate you stopping by, checking us out. If you would, hit the subscribe button. That certainly helps us out. I appreciate that as well. You enjoy the rest of your day. It's back to work for me, and we will do this all again tomorrow. Enjoy.
Hey, wait! Before you go watch one of our other great videos, have you had a chance to see our new Fin Tips videos? They focus on one topic at a time, covering investing, personal finance, and anything that can quickly help you with your dough. Best of all, we'll keep it real short, because we know time is money.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.